Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Heidrick and Struggle stock so we can determine if it's a buy or a sell. Let's get started with the model. They're a small cap company, 538 million market cap. They're trading at $27 a share and they have 20 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is positive every year, which is great. It was low in 2020, only 16 million, way up to 265 million in 2021, dropping to 108 million in 2022. Then it dropped again to 31 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. They had a negative in 2020. Then after that, it's around $70 to $80 million. Revenue is a sales for the company. And that grew a lot from 2020 to 2021. It was over $1 billion for the first time. Then after 2021, it's fairly steady between 1 and 1.1 billion. They're profitable and generating positive free cash flow with only $1 billion of revenue. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.4 billion. We divide that by 20 million shares. And we get a calculated stock price of $70. They're trading at $27, so they're trading at a 62% discount. It's a really strong buy according to the model. Sometimes you need to look for these hidden gems, stocks that other people aren't really looking at. That's how Warren Buffett started out. He would invest people's money, but he would focus on smaller stocks, looking for companies that were undervalued that other people weren't focusing on. Then when he met Charlie Munger and more money was flowing into his fund, it made it more difficult just to focus on smaller cap stocks, so he needed to look at larger cap ones. There are 39 companies in the same industry as Heidrick, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 13 million in capex, which is equal to the median. They have a low debt to equity ratio. For every dollar of equity, they have 20 cents of debt. The average is 1.6, the median 0.5. They pay a nice dividend, 2.3%, higher than the median average. They generate 31 million of free cash flow. They rank 16th in market cap of the 39 companies. They have a great price to book. So investors are paying $1.20 for $1 of equity. Price to book is market cap over equity or stock price over book value per share. They have an amazing PE of 7.0. That's stock price over earnings per share. ADP has a price to earnings of 28. They're the largest company on this list, 92 billion market cap. Their price to free cash flow is between the median and average. This means investors are paying $17 for $1 free cash flow. The way you calculate this ratio, it's stock price over free cash flow per share, or market cap over annual free cash flow. Their price to sales is 0.5, better than the median average. Since it's 0.5, that means their revenue is double their market cap. And they're growing at a great rate. Their 5-year annual revenue growth rate is 10%. Double the median, more than double the average, which is higher than the top 3. Hudson Global is 26%. Insperity is 12%. But they're above everyone else in this list, tied with Korn Ferry. The reason I chose this stock is because I ran a screener in E-Trade. I look for every small and microcap stock, only in certain industries, not every industry. The only filter I included was a company with positive earnings. So if they had negative earnings, they wouldn't show up on this list. After I excluded certain industries and excluded any company with negative earnings, there was 200 tickers. And I just applied a simple formula. If the PE is below 10, price to sales below 2, price to book below 1.5, and debt over total capital below 10%. If that was true in all 4 categories, then I'm going to do a video on that stock. There are only 5 companies that fit these parameters, where these 4 parameters were true. Bridgeford, I did a video on them yesterday. Heidrick. Then I'll do a video on Future Fuel, and I did a video on them in the past. I'll do a video on Resources Connection and Now. Maybe I'll invest in some of these companies. Let's take a look at their last 10Q. This is as of 3/31/2023. We'll look at the income statement first. Their revenue for the first quarter of 2023 is $242 million. It's down a lot from last year of $286 million. Let's see if we get a breakdown of the $242 million so we know what it is. Of the $242 million of revenue, $190 million is executive search. They break down the $190 million by location: $127 million in the Americas, $39 million in Europe, $24 million in APAC. On-demand talent, $31 million. Consulting, $17 million. Then we add $2.8 million of reimbursements. That gives us $242 million. Most of their revenue is executive search, $190 million. Let's figure out exactly what that is. So the main way they make money is if a company comes to them, say Johnson & Johnson contacts them and says, we need 5 employees for these positions. So Heidrick would look for those employees. If they find them, Heidrick gets a commission. They mention it right here. Each executive search contract contains one performance obligation, which is a process of identifying potentially qualified candidates for a specific client position. They have a contract with Johnson & Johnson, and once they find an employee to fulfill that position, then a contract is satisfied and they earn a commission. And I think the commission is 1/3 of the employee's salary. It says right here, compensation is comprised of a retainer equal to 1/3 of the estimated first year compensation for the position to be filled. So if Johnson & Johnson is looking to pay an employee $90,000 and they find that employee, Heidrick receives $30,000, 1/3 of $90,000. They only get 1/3 of the first year of that employee. They don't get their second and third year. If the employee doesn't stay for a full year, I don't think Heidrick would get a full commission. But all that information is spelled out in the contract. And they mention that here. The company generally bills clients for the retainer and indirect expenses in 1/3 increments over a 3-month period, commencing in the month of a client's acceptance of the contract. They receive $31 million of on-demand talent. That is up from last year. Let's see what on-demand talent is. This company enters into contracts with clients that outline the terms and conditions of the assignment to provide on-demand consultants for various consulting projects. And those consultants may be independent contractors or temporary employees. Let's figure out what Heidrick Consulting is. That was pretty much flat from last year. Heidrick Consulting is a complement of their search services. They partner with organizations through Heidrick Consulting to provide advisory services related to leadership assessment and development, organization and team effectiveness, and culture shaping. In addition to finding employees that could work at other companies, Heidrick also provides consulting services. And let's try to figure out what reimbursements are. So it looks like reimbursements are out-of-pocket expenses. So they're additional expenses they charge to companies. Let's look at their operating expenses. Salaries is their main one, $159 million. That went down a lot from last year of $200 million. G&A, $34 million. Cost of services, $23 million. R&D, $5.5 million. Reimbursed expenses, $2.8 million. That also equals a $2.8 million of revenue they receive from reimbursements. So total expenses, $224 million. Operating income of $18 million. Interest of $3.2 million. Other expenses of $1.8 million. Income before taxes of $23 million. Taxes of $7.2 million. Net income of $16 million, down from $18 million. Their shares outstanding increased a little bit from 19.6 million to 19.9 million. So their EPS is down from 94 cents to 78 cents. Here's a breakdown of their operating income by segment. $44 million from executive search. That's how they make all their money. Then a loss of $4.4 million on on-demand talent. A loss of $3.1 million in consulting. So total segment operating income is $36 million. R&D $5.5 million. Support $13 million. That's how we get the $18 million of operating income. Right here is the $18 million. This is the income statement, operating income. Let's try to get a little more color on why the revenue decreased so much from last year. It went from $286 million to $242 million. This section explains it. Revenue decreased $43 million or 15%. The decrease in total revenue was due to the decrease in revenue before reimbursements. This section talks about revenue before reimbursements. Foreign exchange rate fluctuations negatively impacted results by $5.5 million or 1.9%. Executive search net revenue was $191 million, a decrease of $52 million or 21% compared to the first quarter of 2022. That's the big drop, executive search. The decrease in executive search was due to a decrease in the volume of executive search confirmations. There were less companies looking to hire employees through this company. On-demand talent was $31.1 million, an increase of $7.7 million, or 33%. The increase in on-demand talent was due to the acquisition of HSII Group. That was in February 2023. Heidrick Consulting decreased $200,000 year over year. The decrease in Heidrick Consulting was due to a decrease in leadership assessment and development consulting engagements compared to the prior year. The number of executive search and Heidrick Consulting consultants was 432 and 78 respectively, compared to 394 and 70 last year. This income statement gives percentages. Salary is 66% of their revenue, down a lot from last year of 71%. But other expenses went up from last year, so their operating margin is 7.4%. Last year was 10.7%. But their net profit margin is flat from last year, 6.5% in both timeframes. Salaries and benefits decreased $43 million or 21%. That's mainly because variable compensation decreased $56 million due to lower bonus accruals related to decreased consultant productivity. That doesn't sound good. General and admin went up $4.5 million or 15% compared to the prior year. The increase in G&A was due to business development travel, intangible amortization, earn-out accretion, office occupancy, information technology, professional services, and the acquisition of HSII, partially offset by a decrease in hiring fees. Let's take a look at their balance sheet. They have current assets of $446 million, current liabilities of $260 million. So they have a good current ratio. They can easily cover their current liabilities with their current assets. Their cash and marketable securities went down a lot. It was over $600 million in 2022. Now it's $205 million. That's still a lot of cash for a company with $538 million market cap. At the end of 2022, they had more cash than their market cap. They have $160 million of accounts receivables. That's up from $126 million. $31 million of prepaid expenses. That's up from $24 million. Other current assets, $43 million. Income taxes recoverable, $7.2 million. They also have a lot of non-current assets, $445 million. $33 million of property and equipment. Here's a breakdown of the $33 million. $42 million of leasehold improvements, $15 million of office furniture, fixtures, and equipment, $32 million of computer equipment. That's $89 million total. They depreciated $56 million, so the carrying value is $32.5 million. They lease $70 million of assets. I think this is related to leasing office space. It talks about it right here, office leases. The value of the assets they lease is $70 million, and they owe $80 million of lease payments on these assets. Because if you go down to the liability section, operating lease liabilities $21 million, operating lease liabilities $61 million. $21 million of the lease payments is due within 12 months, $61 million is due beyond 12 months. If you sum up the $20 million and the $60 million, that's $81,435. And if you search $81,435, you can see when the lease payments are actually due. $14.5 million due this year, $20 million due next year, 2025, $12 million, $11 million in 2026, $8 million in 2027, and $25 million due after 2027. That's a total of $90.8 million minus $9.4 million of interest, because you don't capitalize the interest payments. If you scroll up a little, it says the lease term is 6.3 years, and they pay between 3.25% and 3.5% interest. Let's go back to the non-current assets. They have $43 million of investments. If you search that $42.5 million, it says it's U.S. non-qualified deferred compensation plan, which doesn't really tell us what it is. But if we search this term, we could get a little more info. They have a U.S. non-qualified deferred compensation plan that's mainly U.S. marketable securities and mutual funds. So that's what they're investing in. Marketable securities are highly liquid investments, like common stock or treasury bills, investments that can easily be converted into cash. They have a lot of goodwill, 198 million. It increased a lot from December 2022, probably from the acquisition of Atrius. And we could see right here, Atrius added 59 million of goodwill. Of the 198 million of goodwill, 91 million is from the acquisition of companies in the Americas, 1.5 million in Europe, and 105 million of on-demand talent. All of Atrius's goodwill went into on-demand talent. Other intangibles of 25 million, deferred income taxes of 34 million. Total assets 890 million, down from 1.2 billion. In their current liabilities, they have 17 million of accounts payable. Accrued salaries went down a lot from 450 million to 140 million. Accrued salary is the amount of money a company owes an employee but has not paid it yet. So let's say every quarter I earn a bonus at my company, a $10,000 bonus, but they don't pay me until my first paycheck after the quarter ends. So for the second quarter, I would get a $10,000 bonus. The quarter ends June 30th. So my first paycheck in July, I'll get an extra $10,000. But if you looked at my company's balance sheet, say on June 1st, you would see that $10,000 in accrued liabilities. So their accrued liabilities went down 300 million. So that's where a lot of cash went, to pay those employees their salaries. Deferred revenue of 43 million. Deferred revenue is when a company receives cash for a product or service they're going to deliver in the future. And they define it right here. Deferred revenue. Contract liabilities consist of deferred revenue, which is equal to billings in excess of revenue recognized. So total non-current liabilities, 210 million. Total liabilities, 470 million. Down from 764 million. A decline of 300 million. So that's where 300 million of their cash went, to pay down their liabilities. Because their cash went down 400 million from last year. It was 610 million, now it's 205 million. Now we know where 300 million of the money went to pay down liabilities, plus the acquisition of Atrius. Let's look at the equity section of their balance sheet. They raised 244 million from selling their business. They profited 181 million from running their business. So equity of 420 million, up from last year of 410 million. Let's take a look at the statement of cash flows. The first section on the statement of cash flows is the operating section. Their net income in the first quarter was 15.6 million, but they had a cash outflow of 337 million. That's from the accrued liabilities, the accrued expenses, $325 million cash outflow. They had such a big cash outflow in the first quarter, and also the fourth quarter, is because of year-end bonuses probably. If we look on the 10K, we can see in all of 2022, a net profit of 80 million, and they generated 119 million of cash flow. You could see a cash inflow of 33 million of accrued expenses. In the first quarter, it was negative 325 million. For instance, if you looked at the second or third quarter of the year, you would see lots of cash inflows for accrued expenses. Most of the cash outflows occur in the first quarter because of year end. Most people get their bonuses in the beginning of January, once the year is closed. Let's look at their investing section. They had that acquisition, a cash outflow of 30 million, 3.8 million of capital expenditures, and they sold some marketable securities so they can pay the bonuses. In the financing section, you'll see the dividends paid. Then there's 36 million of acquisition earnout payments. As part of the acquisition of Atrius, Heidrick has to pay this liability. It's called an earnout liability to Atrius. They mention it right here. When estimating the present value of future cash consideration, the company accrued an estimated 32 million as of the acquisition date for the earnout liability. Let's look at their press release for the first quarter earnings. They completed 2 acquisitions, Atrius and Business 4.0. They maintained strong profitability despite macroeconomic headwinds. 15-cent cash dividend. First quarter highlights: net revenue of 239 million. Operating income of 18 million, adjusted EBITDA of 27.5 million, net income of 15.6 million, diluted EPS 76 cents. They completed the acquisition of Business 4.0 on April 1st. Let's see what they say about this acquisition. On April 1st, the company completed the acquisition of Business 4.0, announced in March 2023. Business 4.0 is a London-headquartered next-generation consultancy specializing in developing and implementing purpose-driven change, and will now become part of the company's Heidrick consulting segment. The big drop in revenue was executive search. Revenue of $191 million compared to $243 million, reflecting an anticipated market slowdown. The company had 432 executive search consultants at March 31st, 2023, compared to 394 at March 31st, 2022. Revenue per consultant in 2023 was $1.8 million, in 2022, $2.5 million. Average revenue per executive search was $124,000, flat with the prior year. The number of search confirmations decreased 22% compared to a year ago. They expect second quarter revenue to be between $260 and $280 million. Let's take a look at their PowerPoint slides for the first quarter. This slide talks about Business 4.0. They're the right partner to help expand Heidrick Consulting's leadership advisory integrated offerings globally. They have a good-looking client base, heightened opportunities for new pipeline and cross-selling across Heidrick Consulting and Search. They have a strong market position in the UK and Europe, and they're expecting to expand in the US. They're headquartered in London. They have about 50 employees. They specialize in helping senior management teams develop and implement purpose-driven cultures and change management in companies undergoing strategy shifts and major transformations. Areas of expertise include purpose, strategy, leadership, culture, and engagement. Atrius is a market leader for C-suite level interim management in Germany and leading provider in Europe. Their services: interim line management, project and program management, C-suite level recruiting. They have more than 15,000 highly qualified and carefully selected managers within their network. They offer staffing and project solutions in automotive, healthcare, IT, and consumer goods. In 2014, their EBITDA margin was 8.5%. It was 11% in 2015. Then it was in the 10s in 2016 and 17. Now it looks like their margins are much stronger. It was over 14% in 2021. Now it's around 12.5% to 13.5%. Their EBITDA margin in the Americas is really strong at 33%. Europe is down from 13% to 6%. APAC is also down from 18% to 15%. And revenue is down by every region when you compare Q1 2022 to Q1 2023. Even though revenue is down a lot this quarter, their EBITDA isn't down that much. It's pretty close to last year. So their margins have improved a lot. Their consultant headcount is up to 432. Search confirmations are down a lot. They're down to 1,500. And they're earning a lot less per consultant, $2.5 million to $2.1 million. The largest industry they work with is financial services, 27%, industrial, 22%, technology and services, 20%, consumer markets, 17%, healthcare and life sciences, 11%, social impact, 3%, whatever the hell that means. At the end of 2022, their cash was highest at $622 million. It's come down a lot to $205 million. The same thing happened last year. December 2021, cash of $545 million. Then the following quarter down to $268 million. At the end of 2020, cash $336 million down to $184 million. The first quarter is when they pay out a lot of the bonuses. Here's a breakdown of the $205 million of cash on hand. $77 million will be for 2024 bonus payments, $76 million for operations, and then $52 million left over. Let's look at this company on Simply Wall Street. Last price was $27, $538 million market cap, down 16% in the past year. They were founded 70 years ago in 1953, 2,154 employees. Heidrick & Struggles provides executive search, consulting, and on-demand talent services to businesses and business leaders worldwide. It enables its clients to build leadership teams by facilitating the recruitment, management, and development of senior executives. The company also offers on-demand services to provide clients with independent talent, including professionals with industry and functional expertise for interim leadership roles and critical project-based initiatives. Also consulting services, including leadership assessment and development, team and organization acceleration, digital acceleration, and innovation, diversity and inclusion advisory services, and culture shaping services. It provides its services to Fortune 1000 companies, major U.S. and non-U.S. companies, middle market and emerging growth companies, private equity firms, governmental, higher education, and not-for-profit organizations, and other private and public entities. They're headquartered in Chicago, Illinois. They list 2 risks. Earnings are forecast to decline by an average of 13% per year for the next 3 years. High level of non-cash earnings. It looks like they started trading in 1999. A year after they went public was their highest stock price, $71. And that was right before the dot-com crash. And the stock fell down to about $13, below its IPO price. Then over the next 5 or 6 years, it ran up to $52 in 2007. That was the last time the stock was above $50. It fell a lot in 2008, 2009, probably because of the Great Recession. And then it was up and down for a while. It had a nice run up at the end of 2021, breaking through $45. It's down around 40% since the end of 2021. They had a price to sales of 0.9 in 2018. It got up to 1.1 in June 2021, but it's currently at 0.5. So the stock looks pretty attractive. Simply Wall Street values the company at $63. They say it's 57% undervalued. 3 analysts priced this stock and the average price target is 38. They say the stock is 40% undervalued. Their trailing 12-month revenue is a little over $1 billion. And the forecast by the end of 2024 is to be a little over $1 billion still. Their trailing 12-month revenue in 2012 was $467 million. And it had a nice steady growth for the next 6 years, getting up to $730 million. It fell in 2020 to $620 million, and then it ran up a ton the next year to over $1.1 billion. It has regressed a little the past few quarters, but it's still over $1 billion. And they always have positive operating cash flow. It was the highest at the end of 2021, $270 million. That's why they pay such a nice dividend, because they're always generating cash. It's a really well-run business. They usually have little to no debt on their balance sheet. Currently, they have no debt. The last time they had debt was in mid-2020. But they always keep a good amount of cash on their balance sheet as well, so they don't run into any problems. And their equity is higher than ever, over $400 million. Remember, equity is assets minus liabilities. And they do pay a good dividend, 2.2%. The industry average is 1.7%. They pay out 16% of their earnings. Their dividends per share are 60 cents, earnings per share $3.82. They were paying a 5-cent annual dividend from 2012 to 2018. Then they raised it to 6 cents, and they've been paying that out for a few years now. Their yield was over 4% in 2012. It has been coming down. Now it's at 2.2%. The reason their yield was a lot higher in 2012 because their stock price was lower back then. The stock price has been increasing over the past decade, so the yield has been going down. And they haven't been really increasing their dividend, very little over the past 11 years. The CEO's regular salary is $900,000, total compensation $6.9 million. Their tenure is 6.3 years as CEO. There's only been one insider trade in the past 12 months, a sell for 3,000 shares. 88% of the company is held by institutions, 5% by hedge funds, 5% by the general public, and 2% by insiders. BlackRock is the biggest shareholder at 17%, then Vanguard at 8%. They had 1,500 employees in 2012. They're at the highest point ever in terms of employees, 2,200. And the ticker trades in 2 places, the NASDAQ and Deutsche Börse. So that's the end of the video. Let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.